those who have attended Moneylife programs obviously know most of this, and those who haven't, for them this is a summary of a much longer program that we normally do. I'll start with the normal journey of virtually every saver in this country. What normally happens is that most of us earn a regular income, mainly salary. Then comes the expenses. As I said, after that things start getting complicated. A lot of people have their money lying in savings account, and then, as Sucheta mentioned, they meet a relationship manager who would normally push them on insurance, which is one of the largest selling financial products in this country, not mutual funds, not any other thing. Or if the market is booming, they'll probably buy a stock or a share, and then they come back and say, well, this is not moving and I've lost so much of money, I'm out of share market forever. Or the more careful of them obviously don't do any of this, but their money is sitting nicely in a bank FD. Now if they do any of this, most people will end up with much less money towards the end of their lives. This is not to create a scare scenario, it is only to point out that you can do much better. You can do far more justice to your money than just keeping it safely in a bank. Unfortunately, because of this journey of the average saver, the four most popular investment destinations are bank FDs, which gives you a low return, insurance, which gives you an extremely low return, the traditional insurance plan, and even ULIPs, gold, which is almost the same over the last 22 years, almost the same as a bank FD, but it comes with costs because it's a capital gain, you have to pay tax on it. And these days, unfortunately, because people are forced to buy expensive properties at all locations in this country, a lot of money is going into real estate, which does give you better returns than all of these three, is our estimate, although nobody knows what the return is. Every individual's return is going to be different, but the problem is that it is illiquid. It's not cash. Okay? Having a house and having a second house is completely different from having actual investments which can be liquidated. Most of these investments, except maybe real estate, I'm not sure of that, as once again nobody knows really what the average return would be, will certainly not beat inflation. But inflation, whether we like it or not, because of the peculiar nature of the Indian economy, which is a high-cost economy and a highly inefficient economy, is going to remain with us for a very long time. And the impact of inflation is quite horrible. If you start with 1 crore of rupees over the course of 30 years, if the inflation rate is 7%, it comes down to about 11 lakhs only of purchasing power. If the inflation rate is 10%, it comes down to only 4 lakhs of purchasing power at 30 rupees over 30 years. In fact, a lot of people, even a chartered accountant of a multinational company who went on to become the MD of that company, said that even I made this mistake. I was very young at that time, maybe 50 years ago. I bought an insurance policy that would give me 1 lakh after 50 years. And I thought that's a lot of money, because 1 lakh 50 years ago was a lot. And now I look back and see, he's a chartered accountant from England and Wales. When I look back and see it was such a silly thing to do, because over a period of 50 years or 40 years later, 1 lakh means virtually nothing. This is what the picture is going to be. So all insurance products are designed to give you a lot of money in today's terms, in today's value, many years later, which is of absolutely no value at all. Our appeal to all of you is try to make your story different and plan the future knowing that this is how you would plan and this is how the reality is going to be. The reality is going to be because of multiple reasons. Every person's situation is going to be different. Everybody will fall into a problem at different points in life or lose money at different points in life. But if you're aware of this, then you can plan for it, for which you need to do just take 3 steps. First of all, you have to save enough. This is pure arithmetic. If your money is what is going into savings and investments, it's not somebody else's money. The more you save, the more your corpus is going to grow. It's very, very simple as that. Now, is what is not recognized very often is how much money people can make out of careful saving and investing. It's almost like having an independent fortune. Okay, remember, it's your money, but the money on money, that is the returns that you can make on a compounded basis on your savings, is just so huge. And for that, the starting point obviously is to start very early as possible, and save as much as possible. I'll give one combined chart, and I have a lot of charts on that, but in this case I'll share one chart a little later to show how it goes. Buy health insurance and term plans early, and this gives you not only a huge choice, because the older you go, the companies start putting different kinds of riders, and they have different policies to reject or not even give you a policy. For instance, last issue we did a cover story not of claims denied, which is a very issue, but policy denied. For some people, many people have not even got a policy, because insurance companies have various kinds of filters. Those are much less when you're much younger. And of course, invest very carefully, which is the core of my few slides that I will do in the next 15 minutes or so. Now, this is a chart that I was talking about. This is quite fascinating. I normally take people through all of these charts individually, but I have combined all of them. I have given 4 scenarios. In the first scenario, somebody invests 10,000 rupees and earns on an average of 10% per month. You can ask me, where will I get 10%? No, it's not bank FD, it's a combination of products. This time is too short to tell you about the combination of products, but let's assume that it's 10%, and it's equal assumption for everybody. Somebody starts investing 50% more, but he starts 5 years later. So you can see the first guy is the blue one, the second guy starts 5 years later, and the third guy, who says that let them start investing, I'll catch up, he starts 10 years later with even higher investments. Now, the first guy, who has put in only 10,000 rupees, ends up with the maximum amount of money. So the guy who started 5 years later can't catch up with him. The guy who started 10 years later can't catch up with him, even though both of them are investing much more than the first guy. This is what the time does to your money. So you start as early as possible, invest as much as possible. This is what's going to be the outcome on an even or an equal basis. This is really the cornerstone. This is very simple. Warren Buffett talks about it. Everybody talks about compounding. People don't understand, simply because we are interested in the next 15 minutes, next 3 months, maybe next 6 months. We just cannot see 30 years ahead of us. Way to invest, it depends on four factors. One, the expected returns that you're likely to get, whether the product is volatile or gives you steady earnings, what is the time frame, which is whether it's a short term or a long term, and what are the goals that you're saving for. This is about it. Now, why is all of this so simple, and why is, again, all of this so complicated? Because people don't explain all of this in very, very simple terms, because it will come in the way of their sales. If they want to sell something, then simplicity comes in the way. They can't sell you a product which obviously you will see through. The first thing to figure out, and Indians are very good at asking this, I don't know why they don't ask about returns, because when you want to go and buy a car, first thing you ask is, what is the mileage, kitna deti hai? So in case of investments, this is your expected return. Let me emphasize, there is a particular notion attached to expected returns. It's a statistical term, but I'll explain that. First, let me run through this. Sensex is up by roughly 14% post-tax after over 20 years. Okay, doesn't mean next 20 years will be 14%. This is where the word expected comes in. But historically, over the past 20 years, Sensex has been up by 14% post-tax. I mentioned post-tax because anything more than 1 year is tax-free. Gold, 9% compounded over 20 years pre-tax. You have to pay a capital gains tax of 20% after you sell. Of course, you get indexation benefit. ULIPs fetch, I've been very generous, 6 to 8% is actually lower than that, and the returns are getting lower and lower with time. It's supposed to get higher with time. Bank FDs, 8 to 8.5% pre-tax. If you have on a higher tax bracket, which is 30%, is just about 6.2%. So what matters here is your individual situation. This is where the expected returns of one person although it's the same for the other, his choice of products start becoming different based on its taxability and other issues. Traditional insurance plans will get you just about 4% or so. There's actually a product of HDFC Life, I don't know if it's still there. We did a cover story on that product itself, which is so extraordinary. We calculated that the charges and commissions in the first 3 years are so high that you're going to get only 2% from that so-called insurance cum investment product of HDFC Life. Okay, real estate, nobody knows, because all of this is possible to calculate. You can calculate the returns of Sensex. Bombay Bullion Association will give you the prices of every year, every day of the gold prices. ULIP prices are, the NAV values are available. Insurance, of course, tells you upfront you're going to get. People don't calculate. If they calculate, they'll know that it's 4% right up front. It's very easy to calculate because they tell you what is the sum assured. That's what you're going to get. Minus the charges, this is your return. Real estate, no nationwide database of real estate returns are available. In any case, returns will differ from year to year. It's like stocks. You start here and end here. If they are different, then the returns will be different. It will differ from location to location, all right? Will also differ from the kind of property that you're comparing. It's an extremely difficult thing to compare. In the US, it's easier because there's National Realtors Association where they report these data. The transaction data is reported. Now, if at all the government decides to make available by hiding the actual buyers and sellers, but they make available the database of every property registration data in the country, we will be able to create a database and say this is the expected return from real estate. But based on my own assessment, my own understanding and my own research, according to me, it is somewhere between little higher than the bank FD. It could be around 9 to 10% on a long-term basis. Always calculate your returns on a post-tax basis and post-inflation basis, because without this you're not going to compare with what actually that money means to you. Post-tax is very easy to understand. Inflation I've already explained. The expected return before inflation and before tax and after tax are two completely different things, especially for people those who are in the high tax bracket. Second is, Sucheta has mentioned that we are not hardwired to understand money. One of the things that we are not hardwired to understand is volatility. The reason is that all our tactile or tangible experiences of real world is all based on cause and effect. We do something, we get a result. If it happens twice, thrice, if I tap here 3 times and it makes a noise, and the 4th time also I will expect it to make a noise. If it doesn't, then something goes wrong with us. This is also the reason why we expect steady income. This is also the reason why we expect a guaranteed income. We are just not able to understand something which goes up and down, because we are not hardwired. That's not the evolution has not made us in that way. All right. So the other problem with volatility is that the reverse is not true, which is why if you see the 2 sentences I've written, low volatility means low returns. I have not written high volatility means high returns. I have written it the opposite way. If you want higher returns, you have to embrace higher volatility, which means there is an understanding issue here. In the first case, there is no understanding issue. Low volatility products will give you low returns, they cannot give high returns. It's given. This is within our understanding, our neurobiological understanding. The second one is not. It's something that we are not used to, which is why most people do not invest in stocks and equity mutual funds. It's not about the company, it's not about the stock market, it's not about your stockbroker, it's not about expected return. It is only about our own understanding that something goes up and down and we do not know how to deal with this. But there is a way to deal with this, which is once again to try and do something again for which we are not hardwired, which is look for the long term. Volatility, very interestingly, reduces with time, and the next 3 charts is going to show you how. This is Sensex returns yearly, okay? Start date is 1990, end date is 2014. And if you can see, you're going to tell me, see, this is why we don't understand stock markets, or we are not interested in it, because this looks completely random. A few years it's up, and then it's down, then up again, then down, and who can figure this out? It's volatile and it's random. not exactly that random as it seems to be, because when you look at a different chart, which is a little longer term chart, and all I've done here is I've grouped 5-year returns. So it's 90 to N94, it's 90 to 95, 91 to 96, and so on and so forth. These are called 5-year returns, not yearly returns. 5-year and removed 1 year each, in, as I have explained, 90 to 95, 91 to 96, 92 to 97, and so on. These are called rolling returns. The moment I do that, volatility is much less than the previous chart. All right. Now, the moment I do the same thing for a 10-year rolling return, 90 to 2000, 91 to 2001, 92 to 2002, and so on and so forth, you would see volatility is gone down even less. I'm not trying to argue that, see, there are no 10-year losses. That's a separate issue altogether. There are no losses in on any 10-year basis over the last 20 years, which gives me so many observations over the last 20 years. But what I'm certainly able to see, and this is true for all stocks, all companies, all markets across the world, you increase the time frame, the volatility goes down. And our main problem is with volatility, but our main problem is also with a 20-year time horizon. We are not able to see this. If I tell you, the moment you step out, you would probably forget about 20 years, because we live, unfortunately, in a 15-minute to 3-month time frame. That brings me to the fact that there are different products which are meant for different time frames. Because equities are volatile, they're horrible for shorter term. If somebody tells you that, hey, listen, I have some surplus money, I need it for a year, should I park it in equities? You should say, absolutely not. This is absolutely foolish idea, because as you saw in a 1-year basis, how the market is completely unpredictable. So if you go by time frame, there are simple principles that you can go with, which is that 0 to 3 years, your capital has to be protected. So the moment I took a 5-year rolling return, all right, so even up to 3 years, there is no question of taking any risk with your capital. There's no meaning to taking any risk with your capital. You need to say you need for a house or a down payment for something or a car or whatever. I mean, if it's up to 3 years, your capital has to be protected, and you can choose your products accordingly. It's not an insurance product, it's not an equity mutual fund, it's not stocks, it's not any of these, it's not, a property, it's just going to be bank FD, probably. That's the only product that you can, even if you buy a bond in the stock market from NSE or BSE, even the bond is a volatile product, exactly like equities, which a lot of people do not know or understand. 3 to 5 years, you can possibly think of mixing some risky and safe products. Only about 5 years or more. We normally say when the market is expensive, it's 7 years or more that you should be able to look at risky products. Why don't anybody talk about this? Because who is going to tell you this? The stockbrokers are interested in you buying today and selling tomorrow, or you buying today and selling within the day. Forget about tomorrow, because they make money on brokerages and commissions. The more you trade, the more is their profit. If they tell you buy this stock and hold it for 7 years, they're not going to get a salary. All right. So this is the main reason that usually people don't talk about this. Unfortunately, mutual funds do mention this, but our research on mutual funds prove that they themselves do not follow, so I'm not going to go there. But you can, if you are able to practice this, most people, I'll share a very small, very interesting anecdote with you. Fidelity, which has now gone off from India, is one of the largest and the oldest mutual fund houses of the US. It's almost 70 years old. They went and did a study of which investors of theirs got the highest returns. There are 2 classes of investors which made highest returns from their Fidelity investments. One, those who are dead, and the other category are those who have forgotten their investments. These are the 2 categories of people who made the maximum amount of money out of Fidelity. All right? Products according to goals. We have all these goals in our lives at different stages, and if you were to match your products to your goals, it's not too difficult, it's fairly simple. This also draws from the previous slide that I talked about, which is in terms of your time frame. If you home loan, for instance, it's a fantastic product. I don't think any country in the world gives so much of tax break. We keep cribbing about taxes, but up to 3.5 lakh rupees is available from interest and principal for your home loan every year. So it's a wonderful product to fund your apartment with. That's probably the only loan that you should take or you need to take. And of course, for different kinds of goals, that you have different products which I've listed over here. Another very interesting point, which I talked about earlier, that if you have higher tax, if you're in a 10% tax bracket, you can possibly invest more in products like bank FD that are liquid and guaranteed. While I believe that it's wonderful to invest in equities and stocks and equity mutual funds, I feel that it has to be tailored to individual risk and also the tax position. You should not take undue risks at all just for the sake of returns. But I would certainly advocate that the moment you're moving up in terms of your tax bracket, 30% plus, we work so hard, and I always marvel at the thought that, my next 100 rupees, 30 rupees is going to go away. We fight for 1 rupee here and 0.5% and 0.25% with the bank for our money, and 30 rupees is just going to go away to the government of India. To these people in 20 and 30% tax bracket have to be very, very mindful of where they invest. They have to earn a return which is tax-free, and they have no option but to invest in equity mutual funds. Otherwise, they'll end up spending a lot of money. At Moneylife, we have listed down all publicly available products under 3 groups, and these are the 3 groups that matter, which are market linked. Remember, I talked about volatility, so you have to look. Volatility is a different way of saying that they are market linked. It means the moment they are market linked, they're going to be volatile. They're going to go up and down, even if it's a bond, even if it's a government bond. All right. If the government bond listed in the stock market goes down in value if interest rates go up. It's as simple as that. Nobody can question that. So market linked, capital fluctuates. So the ones that are in gray, we would say avoid. The ones that are in black are the ones that we say you should go ahead. Second category, fluctuate less but still risky: corporate bonds, debt mutual fund, tax-free bonds. All of these are market-linked products. They will go up and down. And within this, these are the 3 products that you probably need to look at, and none of the others. Suchata mentioned that we believe 90% of the products are not relevant. In fact, many of them are quite harmful. These are a bunch of irrelevant products that you probably don't need. People ask us, shouldn't I invest in government bonds? 8%. Bank gives you 8%. This goes up and down. That is guaranteed. It's a no-brainer. Why would you want to invest in a government bond? Which product groups? Here, most savers' attention is concentrated on this because people value safety above everything else. So these are the safe products. PPF, your capital is completely safe. Taxpayer bank FDs, bank fixed deposits, and then these are also extremely safe, but they're not going to give you great returns. Post office will give you returns, but there are lots of hassles in being able to open an account, redeem, all of this, and people are constantly complaining on our helplines about post office. So we say, why go to post office? Just stay with the banks. To summarize, invest, at least save and invest 25% of your income at least. These are the products that you need to look at, because this is the only way you can beat inflation and earn higher returns. Any other product, try and avoid. Thank you. I now request Harshila to come and start the presentation.